Do I record to the cloud or what? Oh, okay, it's recording. Right. I expected more beginner type of participants, and also because I had only 1 week. I had one last week, a bit of a confusion in the schedule. So it's a lightweight and probably a shorter session. But we can discuss more than last time. I think the first 2 sessions, I did all the talking, and as I said, it's not meant to be a training course. It's still a training group where we're supposed to discuss things. So I'm just going to get going, and you can interrupt me at any point, and we can discuss further, more advanced topics. Okay, presentation. There we go. Okay. So last week there was a request to introduce the SKEW. So I'm sorry if you are completely familiar with that, but that's going to be the topic. And I will go crescendo in the next sessions. And actually, I'm only going to talk about the vertical SKEW for now. As an introduction, you probably know that when Black and Scholes came around in, I think, 73, the assumption was, of course, a geometric Brownian motion and a flat IV across the chain. And things have changed for many reasons. Technology, the 1987 crash. That said, before then, it was correct. So something has changed in the ecosystem, and also the volumes and the electronic trading in the 90s. So a lot of things have changed. So the vertical SKEW, or the SKEW, let's just call it as an IV curve, generally follows a convex type of curve. It is not always that way, but because most of us are US stock or US index options traders, this is something we are more accustomed to. And I think after a while you learn to recognize a SKEW, and this is more typical of a put SKEW. After a while you realize what a call SKEW looks like, what a put and a call SKEW looks like. And as a reminder, for statisticians, this has not much to do with the SKEW of any distribution. Although when you look into the mathematics of it, there are some relations. But we talk. This is the options jargon, not the statistics jargon. So sometimes the SKEW is called the SMIRK or the SMILE. All those things are the same thing. What is important to, of course, understand is that the SKEW is model dependent. Black and Scholes is a closed equation whereby you can extract the IV from price or calculate theoretical price from an IV you've modeled. And the shape, the form, is very much symbol dependent, or at least in some sectors the SKEW will look different. The commodities may be very different. It's also different in Forex. So when you build, there's always a warning, or at least because a lot of people, for example, trade, let's say, an RTT or a Brooklyn Butterfly, or on SPX or RAT, which both have different but still similar dynamics, and then they want to apply it on Forex or commodities, and it doesn't work anymore. It's very important to understand that the underlying instrument is actually important. The SKEW, and I'm not going to explain why the SKEW exists. There are, but the difference, the variation in IV across the options chain is mostly motivated by supply and demand, and there can be more demand for hedges on the downside. And I can come back to what you said. I mean, sometimes when the market falls, it falls hard, and you can see that people will look for hedges, will look for protection, and some protection sometimes at some levels, but as we're going to see, the IV curve is overall fairly easy to model. It's the SMIRK or the SMILE is very often of the same shape. So there are two types of skew. I mean, again, this is the introduction, so let's get things a bit clear. There's the vertical skew and the horizontal skew. I thought I would make a long session and talk about both, but I think today I am not going to mention much about horizontal skew. Also because I want to take things a little bit slower. I think the first two sessions were a bit heavy for some. And lastly, for this slide, even though we could assume that IV is directional, it is not. IV is the projection or the anticipation of volatility forward. But if you, in the model, we can question whether the model is correct or not, but in the model, IV is completely non-directional. So it assumes that there's as much chance the market will go up or down. It is very often a misconception that IV is directional. It is not. If I go back to this chart, we use the IV as the y-axis or vertical axis, and here we use the strikes as the horizontal axis. It is, of course, easier to understand, easier to visualize, and it is something we can easily relate to because the strikes are discrete numbers across the chain. So, and you then figure out the curve and the line in between those data points. But technically, it is not that interesting to use strikes as the x-axis or x-axis. The reason is that you will get a skewed view, and I shouldn't be using that word, but you should a distorted view because of the volatility is actually a projection of a certain percentage either side. So it's better to actually change the x-axis for moneyness. Moneyness, there again, because it's a basic introduction. In this instance, I mean the moneyness as, let's say, a mathematical tool or a way to calculate a curve or to interpret the IV curve. But I checked on the internet what most people, mentors or whatever experts tend to say about moneyness, and they'll only mention it's all about the strike being ITM in the money or ATM at the money or OTM out of the money, and it's about extrinsic, intrinsic value of your option. I think it's very much oversimplistic, and considering that not many traders take their position to expiration, we shouldn't really look at what it means in terms of, I mean, not many traders really look at intrinsic, extrinsic value, at least waiting for the options to expire. I know a number of beginners do that, but in any case, this is not moneyness in that simple fashion. And again, for moneyness to be more symmetrical, we often use the logarithm of x. X is the strike and S is the price of the underlying. So we can then plot a better looking curve or IV curve. and it will be because of that symmetry. I mean, I will show an example just now, and you will see that it does bring about very interesting properties. I said that I would not touch much about horizontal spread, but there is a adjusting factor that, and that there's no actual academic definition of moneyness, actually. I've read a number of papers, and some people will, of course, it's all based on X over S, but some people will adjust, compensate, and do tiny nitty-gritty modifications, sometimes just to look good or be different. But anyway, something that to me makes sense is actually to multiply it by the square root of time to expiration. And it has quite an interesting effect on the Vol surface calculation. And that's not something I will touch on today, but maybe in the next session or the one after next. Because after introducing the horizontal skew, there are a number of things I want to bring the general understanding of options into people's mind, but we will get to Vol surface. I mean, this is my almost my passion, but I understand that now that I'm starting to introduce, and I don't like the word teach because again, this is not a course, but I understand that there's a bit of a gap that we need to, so we'll go step by step. Something that we need to bring in now when we talk about vertical skew is a few words on put-call parity. So put-call parity, again, a few slides back, there are lots of references on Google, on the internet, Wikipedia, Investopedia, and it is a formula that looks like that. Basically, put and calls are interrelated otherwise, and that's a basic premise of Black and Scholes. There would be arbitrage opportunities. So a lot of people tend to simplify it and say, well, the difference between call and put prices is equal to the underlying minus the strike. The actual formula is more like exponential of minus RT, or meaning the risk-free rate, and T, the time to expiration, times the forward minus the strike. This is the more correct approach. But again, when on different sources, different references, you will see different formula, and I understand it's sometimes good enough to simplify. And I will have a session on put-call parity and how important it is. But why did I introduce put-call parity is that in this instance, and this screenshot comes from my program. So this is not today. I mean, this is a screenshot I did, I think, last week. Or here I plot, and my program allows for combining put and call skew curves, or plot them separately. But because of put-call parity, and that's why you can stitch the two curves, because the IV on both sides should be more or less the same. Again, because of the important condition of no arbitrage. So this is a typical put skew. I mean, of course, is there something typical? The graph I showed earlier looked more like a SMIRK or smile, and this one looks pretty straight. So we'll get to what influences the shape, but for now, what is important to understand is that both curves should be able to be stitched together. So of course, there will be a trough here and the call skew, but also the put skew. But the put skew far in the money is less interesting. Another thing that is important when you want to model or extract IV out of prices is that you are, of course, very much dependent on data quality. And if you are far out of the money, the liquidity is, I'm talking about puts, liquidity is small, and so pricing is not so accurate. And if you are deep in the money, again, I'm talking about puts, it should be simpler because although I said it's not something we take too much into account, but I'm talking about intrinsic and extrinsic value. But the other thing that comes into account is how amenable market makers are about pricing an option properly, accurately. We cannot ignore that they have their own agenda, they have their own books to balance, and what we see is that even if you have some liquidity, not as bad as far out of the money, the bid ask can be pretty wide. So the mid, which is used to make the calculation, is of course somewhere in the middle, but it doesn't mean that if, and sometimes I have to close a position that with puts which are now somewhere in the money because the market has shifted down, and you realize that you probably have to give in a little because, and it's only when you get an actual execution that you will know what the pricing or the modeling the market makers are using. But again, this is not an exact science. We're using a framework, and data is what it is for, and it can be, I wouldn't say wrong, but it can, I mean, there can be anomalies, and it can, actually more often than not. So to come back to what I just said, this does not apply for American options. I didn't say it is wrong. I said not so true. The thing is that, and there will be a session on differences between European and American options. We will see what academics say about when it could be interesting or valuable to exercise an option. Sorry. There must be someone talking, but I can't hear anything. I don't know who's trying to talk, but I can't hear a thing. Has been hanging out at 2030 for a long time. It's going to get way above numbers. Every time there's a plane crash, someone gets hit, and eventually finally it's the best buy. Sorry, I see there's only one with the mic on at the moment, Wes, and I can't hear a thing. You're absolutely right. The way I deviated it, though, is instead of selling a 1 week option, I went way further out with a 4 or 5 month option. I'm sorry, I can't hear a thing. I didn't want to see this back go to 9. Can I mute you for a while and we can discuss later? There's something wrong with your sound. I moved on the put spread, and then I got to start all over by selling for 10, 7, and I got to spread all over again. In hindsight, I probably should have, but it, you know, it wouldn't have done it good because the fact found. Okay, so hi Gary. Yes, sorry Wes. I mean, it's a bit rude, but I had to mute your mic so that we can carry on. I'm very happy Gary is here because he's quite clued up in this field. Please don't have too much expectations because, as I said, it's the shortest session. I only had a few days Anyway, I think I'm going to split it into several sessions. Okay, so here is a, and again, I didn't want to talk too much about horizontal skew, but let's now have a look at European options. It's typically, I think it was SPX. And here I use in the x-axis my own moneyness. Again, there's no definite leading formula for this. And here I'm actually not even using the underlying itself, but the synthetic forward that I calculate. What is important here to notice is that, of course, because there are European options, the two curves, put and call, must be able to be stitched. They should form together something that looks like a smirk or a smile. And here you can see, and that must be either far as which curve is this? This is the call. So it's far out of the money calls. The curve seems to be behaving a bit erratically. I mean, they are, of course, pricing issues at both ends. A lot of us are predominantly put options traders. So what is important is, and actually interesting to see, and here I'm only showing two expirations, is that all the way, I mean, because it's moneyness, I can't tell you exactly the price points, but it's probably about 200 points here. What you can see is that on the put side, from near the money to out of the money, the skew or curve is actually fairly flat. I would even think that for many traders and the popular strategies, even though it's an empirical approach, a lot of mentors, experts don't even go that far into the detail, but it makes sense to choose a strategy where the volatility across strikes is almost predictable. You can more or less figure out, and if you look like here, I've actually plotted a simple it's actually parabola, degree 2 polynomial fit. You can see that it's pretty flat. I mean, this factor is next to 0. So whether you do it empirically, or you trade by intuition, or even trade by simple rules, from this perspective, it will always be easier to trade here on the put side, because when you move from one strike to the next or across a number of strikes, the volatility will be fairly predictable. So of course, this is a snapshot taken at a point in time, but of course, if you had a more erratic volatility behavior across the chain, you would put a bearish broken butterfly or PCS, and you could have very erratic pricing as well. At least it makes our working environment simpler. The other thing that we can notice from this chart is that by using that compensating factor, sigma, which is the IV, ATM IV, and the square root of the time to expiration, and Gary, who's done a lot of work in that field, will confirm and probably add to this, is that by using that compensation across expiries, you see that actually the put skew is fairly stable, and the slope is also similar. So it makes also our life easier when you want to roll over a position to the next month, for example, to know that not only your trade, your position is behaving in a in a way that can be, if not predicted, but with a high level of predictability, and it's going to be the same when you roll over to the next session and the next and the next. The gap between those two expiries is 1 month in this case. So when you analyze SKEW, it's actually interesting to be able to plot it in a way that you can understand some stability in an otherwise pretty mad market. Okay, now, and this is something I plotted from IB earlier today. Now, of course, when you start modeling, and in the previous slide I said, well, in most cases you can use a parabola, and for out of the money, it's pretty straight, so you can even actually take it as a straight line. Not always the case. And even though, for example, at this point, August 2019, we have some volatility coming back. We understand that that volatility is coming back pretty close to all-time highs. So there is a level of nervousness which could be unusual, or at least it is definitely not the same optimism that we had in 2017 when the market was teasing with all-time highs. So it shows, because again, the SKEW comes from supply and demand. So this is not an anomaly. It is just a market condition that we have to take into account to some level. I'm not saying that we need to change the way we trade, but it probably shows that if IV is higher, or the concavity, it should be convex or flat. So it shows that there are price levels where the level of hedging is higher. So at the moment, I would say that, and it would probably concur with some analysis that, okay, if we look at IB, or if we look at a chart, we would see that we've been in a trading range. So more or less people will delta hedge their trade in that range. Okay, I mean, there's some nervousness. Maybe we'll have a double top on the 3,000 level, almighty level, and the market will drop. But it has already corrected once or twice to 27.25 and recently to 28.25. So that shows that that can explain why there's increased hedging in that area. So this is not my intention to mess around and make things more complex than they are, but there's always something to read in a curve. And we can see the level of hedging here, and this is specific to this market condition. So as I said, I wanted to make this session short so that we can then discuss. Something I've read from a variety of sources is that there are, of course, the people like me, more mathematically inclined, who will try and model through polynomial regression how the vol is supposed to behave in a large price range. And I would say that it is comforting that in most cases it is pretty good. There are some market conditions like now that show, I mean, something slightly different. And some people just don't want to go into any heavy math. And there are a few, I would say, some stack type of rules for those who just want to do some quick calculations at the back of an envelope to figure out what volatility is doing. And of course, it's like a technical indicator when you try and figure out what the market is doing. You just simplify some behavior into something simple that will become your benchmark, your gauge. Something I've seen is that people do calculate the 25 delta put volatility minus the 25 delta call volatility. They divide it by 50 delta volatility, and they come up with something that for them represents the skew. To me, it's far too local, but again, you know, there can be a lot of simpler recipes for those who don't want to do any charting, any graphing, any modeling. There's a topic I will touch on in a future session, because it's also something that is, I wouldn't say popular, but I mean something that has been around for probably the last 20 years. It's what they call sticky strike or sticky delta, and there are some other volatility regimes, sometimes a mix of two. The sticky strike is that when the market moves, is the volatility at a strike level staying constant? That could be the sticky strike. So that's something also that you can measure simply. You just look at what volatility on a given strike of interest, what it was before the move, is it more or less the same now? And there's a sticky delta, which at the same delta before and after the move, is volatility the same? The problem theoretically and academically is that the sticky strike rule, if it was correct, it would allow for arbitrage opportunities. So it's like a virtuous circle. It can't be correct because it's against the model. And of course, we use a model to calculate our volatility. But generally, again, this I can appear like a little bit of a nerd or egghead and come with far too much math, but I do respect the simpler volatility measures. And of course, they've been around, they've become popular, so they are there for a reason. So a sticky strike, and again, coming back to the graph earlier about the, I wouldn't say funny shape, but unusual shape of the vol curve. Sticky strike is generally more valid in range trading. Sticky delta is supposed to be more valid in trending markets. So, and again, depending on your time frame and how you calculate what is a trending market. I mean, it can be visual, of course, but technically should be able to be, it should be measurable as well. But so you might want to look at sticky strike in a range trading market and sticky delta. But I'll have that later in in another session. What I also showed today is that the different scales, and here I showed, I mean, IB only shows strikes and volatility. I mentioned that you can use some moneyness, and there are different types of formula for moneyness, and I recommended one. And the same could apply on the y-axis. You can actually use the ATMIV as a reference and use a logarithmic scale of, let's say, percentages away from ATMIV. And this also will give you a different look and a different way. I mean, it's in mathematics with changing dimensions. This is a 2D chart. So this is a plane. So, but by changing dimensions, you can have a better picture of the dynamics and behavior of here volatility, and it's actually quite easy to then convert back to the original dimension. So these bijections or conversions are do not impose extra prerequisite or hypothesis. They're generally pretty good. It just gives you a better picture. You model then according to the picture, and then you can actually turn them to the original values. Right, that's it. I've talked too much. And since I've got a group of very smart people, it's time to discuss. So if you want to unmute. So any questions or anything you would like to discuss more specifically? Gary, I'm sure you've got a lot to say. I mean, you've been working a lot in on that field.
I don't have a lot to say about it, but the whole deal about the sticky strike, sticky delta, sticky moneyness thing, I looked at that one time, and currently I just, for my personal stuff, I just stick with sticky strike stuff, which is similar to toss and similar to the EIYO model, and I know it's wrong, but I have some comfort in knowing that I'm using something that's very simplistic. But at one time, a couple years ago, I tried to look into sticky moneyness, which in my mind, it seems like that should be more correct than sticky strike. And I think I got tangled up in some errors I was making, so kind of abandoned it. But someday I might look at it again because it seems to be logical, or more logical.
You're absolutely right. Absolutely right. I haven't read a lot on, I mean, it does make sense, at least empirically. I mean, I would have the same intuition. The fact is because there's no single definition of moneyness, I think it has not really gathered momentum. But I fully agree, because moneyness will give you a better view on the distribution, so to say, of IV, left and right of the money. Yeah, that's something, if you don't do it, I will definitely look into that. Yeah.
Yeah, so at some point in time when I get another head of steam, I might go at it. I think I had a typo somewhere or something, because my results seem to be out of whack, and I guess there was a whole lot of computations in it, so I could have had a boo-boo anywhere. So just debugging it was kind of a large task. But I have seen some people that actually use a percentage of sticky strike versus a percentage of, I don't know if it's a form of moneyness or a form of delta. And they seem to be like Steve Spear, I think, does that, and he seems to be happy with it. And that somehow that basically kind of, to me, seems to imply like there's some kind of inertia in the IV, which it could be. I don't know, but it also could be a kind of curve fitting, right? To data you've seen that's. I'm afraid I'd get in trouble going down that.
Yeah, but it's also quite exciting. Yeah. Also, as I said, we do extract IV using model, and by default, when no model is being mentioned, it's Black-Scholes. And what I've seen in a few papers, and I could mention Emmanuel Derman in America. He's a South African chap, but nothing to do with my attachment to South Africa. But he's more of a Heston guy. That's something that I don't want to touch on too quickly, but because we're just beginning with Black-Scholes. But there are other models. We know, and especially if we talk about IV, so volatility in general, we know and understand that Black-Scholes does not deal well with price jumps. There have been modifications, improvements. If you Google it up, you will just have to look for jump diffusion models. But there are models that are, I would say, radically different. They don't try and fix something. They look at it from a very different perspective from day one. I would say it's a Heston family. The same way that we can talk about the Black-Scholes family and its multiple variations. And by the way, I mentioned earlier the put call parity for European options. Some people think that the Bjerkson-Stensland model that is quite often used for American options, they think it's something very different. And no, it's a minor add-on to Black-Scholes, just to deal better with the probability of exercising. But it's still the same family, and it still suffers from the same weakness, especially when the volatility shifts rapidly, drastically, from one day to the next. Heston it's not exactly the holy grail either, but it does the best job at it. And you will see sticky strike, sticky delta, and as I said, other volatility regimes sometimes being used with other equations. So, you know, we can change. You mentioned sticky moneyness, very good idea. And I mentioned several possibilities to plot those curves differently, and there are many more. But of course, the bottom line is how you calculate IV, and it's of course based on a model itself. Yeah. Andrew, you're all silent now.
Well, you know what? I enjoy this because I love learning about it. But to me, it's of extremely limited value as a retail option trader. And let me explain why. If you're a market maker, you are out there putting a bid and an offer price on a whole bunch of options continuously. So you don't choose when or what you trade. So your edge comes from price.
Mm-hmm.
And if you're a market maker, this is the kind of stuff that is, you know, extremely important, because you have to get your bid and offer prices correct, because that's where your entire edge comes from. You know, you're out there putting up a bid and an offer, but it's the, you know, you don't choose what you trade or when you trade. It's the customers who decide what and when to trade. And that's where their edge comes from. You know, as a retail trader, my edge comes from picking what and when I want to trade. I have to trade at the market maker's price, but I can choose, you know, what options and when I want to trade. So, you know, as I said, you know, this is a very limited practical use for me as a retail trader. I enjoy learning about it because I find it fascinating, but it's not really going to help me be a better trader. You know, my edge comes from looking at the market and deciding, well, you know, these conditions are good for putting on a butterfly, or, you know, those conditions maybe I want to put on a calendar spread. You know, volatility is low right now, so I'm going to, you know, maybe not do anything and wait for a, you know, jump in volatility to put something on, you know, et cetera, et cetera. But,
Mm-hmm.
you know, having you know, it doesn't really help me to get, you know, an exact option price for each strike, because I'm not, you know, I'm not making the market. You know, I can, you know, I can choose to trade or not trade if I like the prices or I don't like the prices, but I don't make the prices. You know, the market makers are the ones who are making the prices.
Yeah. Yeah. No, I understand what you're saying, and I mean, I would say the vast majority of traders would say the same. So it's actually a very good point. I think if you are a little bit more advanced, you first, it's comforting to see that and of course it probably also confirms that empirical approach, but it's comforting to see that, okay, your vol skew seems to be behaving okay, and whether I choose to place my brokering butterfly or at this level or that level, it will have an effect on my four usual Greeks: delta, vega, gamma, etc. And sometimes you will see that, well, price-wise, it may be more interesting. And the change in the Greeks will be minimal. And price-wise, it looks like more interesting. So, and again, I've got nothing against using your knowledge, experience, which I would call empirism or intuition. Yeah. But it does try, I mean, what I'm trying to do is to uncover and maybe put words and numbers on intuition. I still believe that when you know more, you trade better. I mean, it has worked on me. I know it works on a number of traders. I mean, if you don't want to, if you want to, because for your, I mean, I'm not talking about you personally, but for anyone's confidence and comfort zone, you don't want to be bothered by things that really look complicated and could confuse me more than anything else. I completely understand that. But I've seen, for example, in Ron Bettino's community, he makes spreadsheets, for example, to try and figure out where whatever structure should be better placed. And again, I mean, you can choose to put it lower, higher, and at the end of the day, it's maybe a tiny edge, but it is still one. But again, a vast majority will just stick to rules, what they're comfortable with, and I will definitely not deny that the self-confidence and feeling strong about your approach is more important than learning new things, or it must be done gradually. So you're not wrong, but I'm just trying or suggesting that traders should try and push the envelope a bit further, simply because it's, for me, I mean, Tom is a pilot. To me, it's like flying an airplane, and it's all about dealing with emergencies. So if you understand what's going on, there's better chance that you react more properly. Because I am not a big fan of strictly rule-based trading, delta alert, and I shouldn't say that because the Rhino is meant to be a simple delta-based strategy. But it's, what do you do when things go wrong? And a lot of things have gone wrong in the last 3 years. Markets have changed completely. I don't know whether it's AI bots or there's something changing the market. And my assumption is that you'd better know the what's going on under the bonnet, because simple rule-based trading, the good old days are over, in my view. So of everything I'm presenting, if guys should take 10% of it, at least that's something. Because be sure that in the next, I mean, people who backed it for the last 10 years, to me, it's a waste of time. It's good for learning, it's good for self-confidence, but markets are changing big time. When I have time, I will try and you know, bring it out as well to show in statistical terms what has changed. It can be the SKEW curtices. There is something that is changing. I can't really put my finger on it yet, but since Brexit 3 years ago, and then the presidential elections and the roller coaster since, the market is different. And it's also the main reason why I'm building my own platform, because I want to be able to trust what's going on. Anyway, we're coming to an hour. Yeah, if you have any more questions.
Yeah, you know, the history of markets is that they become, you know, more efficient and edges disappear. I mean, you know, just in the time that I've been doing this, you've seen the iron condors, which were very popular and very profitable for a long time, became unprofitable. And now it seems like the age of the kind of butterfly, especially rules-based butterfly, that age seems to be over.
Exactly. And I don't know what's going to be coming next. If I look at, I mean, if you just look at, for example, John Locke, I mean, he's one of the best references. He had his British butterfly, his M3, and then he got technical with the Rock or M21. And now he's into, I don't know, a dozen of different X4 to try and cover all possible markets. X4 being more a brokering butterfly strategy. So is that fashion or fad, or is it a response to changing markets? It looks like nobody trades the British butterfly, or maybe they do because it's so simple. But the M3 comes in all shapes and colors. So I think there's either another form of combo that will suit a majority of traders' risk appetite, or in my view, it's going to be a total mess. And if it's a mess, and with no, the broken butterfly is still doing okay. Let's not just say that things are over. It's just that simple rule-based strategies, they don't work. They don't work anymore. Yeah, and so either you wait for the next good one, or you adapt, you adjust, and that's what I'm doing. My rhino is not Brian Larson's original rhino, and even my own rhino has evolved because I picked up some weakness on the upside, for example. So I don't know. I'm not a very good designer of a new rule-based strategy. I mean, some people are very good at that. But for people who tend to trust me and my stuff, I still try and simplify and keep the number of rules or variations as simple as possible. But I don't think I will ever get to a simple delta-based strategy anymore.
No, the markets are requiring you to be a better, smarter trader.
Yep. Yeah. Anyway, I hope this training group will be of interest. Talk about it so that we can form a bigger and more interesting group. I'm very happy that you joined. I mean, we were 5 or 6 last week, and unfortunately, they seem to have been A little bit snowed under by the mathematics of it. So, but anyway, yeah. It's not easy to pitch at the right level. But I'm sure that people who just watch a recording, after a while, they will get to it. So. Anyway, we are at an hour. So there will be no session next week. We'll get back to the normal schedule. So the next will be in 2 weeks' time, and I will cover more about volatility and maybe get to vol surface. There's one topic here I haven't actually touched at all, and I should have, is how those volatility curves change according to time and volatility, ATM volatility, and the shape. Those things we will probably look into next time. How the vol SMIRK actually shapes up over time, of course, and differently according to the volatile environment. So more to come next time.
Thank you, Bruno.
Thank you. Thank you, Gary. Thank you, Andrew. And thank you to the silent ones. Thanks to the silent ones too. And please come back next time. Okay. Oh, there's one question. Oh, thank you. Okay, cool. Okay, see you next time. Bye-bye.